Hey everyone, and today we're diving into the world of investing with some timeless wisdom from the Oracle of Omaha himself, Warren Buffett. Now if you're even remotely interested in building wealth, you know Buffett's name carries some serious weight. The dude's a legend, plain and simple. Over decades, he's built Berkshire Hathaway into this massive conglomerate. And his investment strategies? They've made countless people millionaires, including himself, obviously. So, what's the secret sauce? What's the magic formula? Well, Buffett's philosophy boils down to a core set of principles, 5 golden rules that have guided his success. In this video, we're breaking down each rule step by step so you can start applying them to your own portfolio. Let's get right into it. Alright, rule number 1, and this one's a biggie, is to never lose money. This might sound like a no-brainer, but it's a principle that many investors overlook, especially when they're caught up in the excitement of the market. Sounds simple, right? But trust me, it's way easier said than done. The stock market can be a roller coaster, and it's easy to get swept away by the highs and lows. You see, most people jump into the stock market chasing those hot tips, looking for the next Tesla or Amazon, hoping to get rich quick. They hear about someone making a fortune overnight and think they can do the same. But Buffett, he plays the long game. He understands that true wealth is built over time, not overnight. His strategy is about patience, discipline, and a deep understanding of the companies he invests in. He's all about minimizing risk and protecting his capital. For Buffett, the key to success is not just about making money, but about not losing it in the first place. Think of it like this. If you lose 50% of your investment, you need a 100% gain just to get back to even. That's a tough hole to climb out of, and it's why avoiding losses is so crucial. That's a tough hole to climb out of. The emotional toll of losing money can also lead to poor decision-making, creating a vicious cycle of losses. So how do you avoid losing money? Well, it starts with thorough research. You need to understand what you're investing in, not just follow the crowd. Don't just buy what everyone else is buying. Popular doesn't always mean profitable. Sometimes the best investments are the ones that aren't on everyone's radar. Understand the businesses you're investing in. Look at their financial health, their management team, and their competitive position in the market. Look for companies with a solid track record, strong financials, and a competitive advantage in their industry. These are the companies that are more likely to weather economic storms and come out stronger on the other side. And remember, it's okay to sit on the sidelines if you don't find anything that meets your criteria. Sometimes, the best move is no move at all. Cash is king, especially when the market gets volatile. Having cash on hand gives you the flexibility to take advantage of opportunities when they arise. Patience is key, my friends. The market rewards those who are patient and disciplined. Don't rush into investments just because you're afraid of missing out. Don't let FOMO, fear of missing out, lead you to make rash decisions. It's better to miss out on a potential gain than to suffer a significant loss. Remember, Buffett's #1 rule is all about preservation. It's about keeping what you have and growing it steadily over time. Protect your hard-earned money, and you'll be in a much better position to grow it over time. By following these principles, you can build a solid foundation for long-term financial success. Rule number 2 is short, sweet, and straight to the point. Never forget rule number 1. See what I did there? It's almost like he knew we'd need that extra reminder. But seriously, this rule is all about emphasizing the importance of that first principle. It's about ingraining it into your investing DNA because let's be real, the market can be tempting. You'll see stocks soaring, everyone around you making money, and that little voice in your head might start whispering, maybe I should throw some money in too. But that's when you need to take a step back, take a deep breath, and remember rule number 1, never lose money. Don't get caught up in the hype. Don't let emotions dictate your investment decisions. Stick to your strategy, focus on the long term, and always prioritize protecting your capital. Alright, moving on to rule number 3. Invest in what you know. This principle is crucial for anyone looking to make informed and confident investment decisions. It's not just about picking stocks or assets that seem popular or trendy at the moment. Instead, it's about diving deep into areas where you have a genuine understanding and expertise. This one's all about staying within your circle of competence. Your circle of competence is essentially the realm of knowledge and expertise that you possess. It's where you feel most comfortable and confident making decisions because you understand the nuances and intricacies involved. Buffett's a big believer in this. Warren Buffett, one of the most successful investors of all time, often emphasizes the importance of investing within your circle of competence. He argues that knowing your limits and sticking to what you know can significantly reduce risks and increase your chances of success. He's always saying that you don't need to be an expert in everything, but you do need to be an expert in the things you invest in. This means that you should focus your efforts on understanding the businesses, industries, and markets that you are already familiar with or are willing to learn about in depth. So, what does that mean for you and me? It means that we should take the time to identify our strengths and areas of expertise. By doing so, we can make more informed and confident investment decisions rather than relying on speculation or hearsay. It means sticking to industries and businesses we understand. For instance, if you have a background in technology, you might feel more comfortable investing in tech companies because you understand the products, the market trends, and the competitive landscape. If you're a tech whiz, maybe you dive deep into the world of software or semiconductors. You can leverage your knowledge to identify promising companies and make informed investment decisions based on your understanding of the industry. If you're a retail guru, maybe you focus on consumer goods or e-commerce. Your experience in the retail sector can help you spot trends, understand consumer behavior, and evaluate the potential of different businesses. The point is, don't invest in something just because it sounds fancy or everyone else is talking about it. Avoid the temptation to follow the crowd or jump on the latest investment bandwagon without doing your own research. Do your research, understand the business model, the competitive landscape, the growth potential. Take the time to analyze the fundamentals of the companies you are considering investing in. Look at their financial statements, management team, market position, and future prospects. If you can't explain it to a 5-year-old, you probably shouldn't be investing in it. This is a simple yet powerful test to ensure that you truly understand what you are investing in. If you can break down the investment thesis into simple terms, it means you have a solid grasp of the key factors. Remember, knowledge is power, especially when it comes to putting your hard-earned money on the line. The more you know about your investments, the better equipped you will be to make smart, informed decisions that align with your financial goals and risk tolerance. Rule number 4 is all about those fundamentals, baby. We're talking about looking beyond the stock price and digging into the nuts and bolts of a business. What are their financials looking like? Do they have a strong track record of profitability? How much debt are they carrying? These are the questions to ask before investing in any company. Look for a history of consistent earnings growth, a healthy balance sheet, and a management team that knows what they're doing. Avoid those fly-by-night companies that might be here today, gone tomorrow. Focus on companies that are built to last, the ones that are going to be around for the next 10, 20, even 30 years. And you know what? That makes sense. Because when you invest in companies with strong fundamentals, you're not just buying a stock, you're buying a piece of a solid business, a business that's positioned for long-term success. And finally, we've arrived at rule number 5. Be patient and think long-term. This principle is perhaps the most crucial of all, and it's one that Warren Buffett has mastered over decades of investing. This is where Buffett's true genius shines through. His approach is not about making a quick buck or riding the latest market trends. He's not about chasing quick profits or timing the market. Instead, he focuses on the intrinsic value of companies and their potential for long-term growth. He's all about finding those undervalued companies with long-term growth potential and holding on to them for dear life. This strategy requires a deep understanding of the businesses he invests in. He's known for saying his favorite holding period is forever. This isn't just a catchy phrase, it's a reflection of his investment philosophy. And that's not just some catchy phrase, he means it. Buffett believes that if you've done your homework and picked a solid company, there's no reason to sell. Because he understands that compounding is the most powerful force in the universe. The magic of compounding can turn small, consistent gains into substantial wealth over time. The longer you let your investments grow, the more time they have to compound, and the bigger your returns will be. This is why patience is so vital in investing. But here's the catch: compounding takes time. It's a slow and steady process that requires you to stay the course, even when the market is volatile. It's not going to happen overnight. You won't see massive returns in a few weeks or even months. It takes years, sometimes decades, to see the true benefits of compounding. You need to be patient. This means not getting swayed by short-term market fluctuations or the latest financial news. You need to be disciplined. Stick to your investment strategy and avoid making impulsive decisions based on fear or greed. You need to resist the urge to panic sell when the market inevitably takes a dip. Market downturns are a natural part of the investment cycle. Remember, you're in it for the long haul. Investing is more like running a marathon than a sprint. Think of it like planting a tree. You wouldn't expect a sapling to grow into a towering oak overnight. You wouldn't dig it up every few months to see if it's growing, right? Instead, you water it, give it sunlight, and let nature take its course. No, you give it time, you nurture it, and eventually it bears fruit. The same patience and care apply to your investments. Investing is the same way. Be patient, my friends. Trust in the process and give your investments the time they need to grow. Good things come to those who wait. In the world of investing, patience is not just a virtue, it's a necessity for achieving long-term success. So, there you have it, Warren Buffett's 5 golden rules for successful investing. Let's do a quick recap. Never lose money, ever. Never forget rule number 1, it's crucial. Invest in what you know and understand. Look for companies with strong fundamentals and solid growth. And be patient and think long-term always. Now I know what you're thinking. That's great, but how do I actually apply these rules to my own portfolio? Well, that's where the real work begins, my friend. It's time to do your research, identify companies that align with these principles, and start building your own path to financial freedom. And hey, if you found this video helpful, hit that like button, drop a comment down below, and don't forget to subscribe for more investing tips and tricks. Until next time, happy investing and good luck.